Welcome back to Bazaar Open Exchange here on CNBC-TV18. Well, Tata Elxsi, that's the stock that's been in focus. Yesterday, in reaction to the numbers, we did see a big move. Today as well, it's piling on the gains. This after the company posted a solid set of quarter 3 numbers. The revenue is up close to around 33%. The margins as well expanded by close to around 300 basis points this time around. Mr. Manoj Raghavan, the MD and CEO of the company, joins us. Hi, Mr. Raghavan. Well, it's been a satisfactory performance. Your shareholders will be very, very pleased with what they are seeing, both in terms of the company's performance and the share returns as well. But a couple of factors I want to quiz you on. One is your revenue growth at the 9-month mark is roughly around 36% or thereabouts. And your margins, well, they've improved to around 30.5%. For the year, can you end with this growth of around 35% in terms of revenues? And are the margins sustainable?
Morning to you and to your viewers, and thank you for having me on the show today. Yeah, we have been consistently growing, in the 6 to 7% quarter on quarter, and I see no reason why we cannot continue that trend. So I'm pretty bullish on, being able to end the financial year on a good note. So yes, I would be pretty confident on what you've said.
Okay, so you'll end the financial year on a good note, and consistent growth is what you're looking at. So, I wanted to talk a little bit in detail about the kind of opportunities that you're getting in the electric vehicle space, because in your press release, you said that you're seeing significant growth in the automotive market with large and strategic deals with both OEMs and suppliers across electrical, autonomous, connected and digital. Can you tell us what are the size of these deals right now? Have the deal wins gone up over the last 2 or 3 months because of the rapid adoption of electric vehicles? And what could the opportunity be for a company like you?
Yeah, I would say, the growth that you see today, I mean, whatever we have, talked about in the last quarter, again, is not, primarily because of deals that we won in that quarter. We have been winning deals, over the last, 4, 5, 6 quarters, right? So many of the ramp ups that has happened and so on has really contributed to the performance that we have seen. So what that means is even deals that we close, in this quarter or the previous quarter, we will see the ramp ups of that happening in the subsequent, 2 or 3 quarters. So yes, there is a good traction. We continue to win good deals, and that gives me the confidence that moving forward, we will be able to continue the growth momentum.
No, so my question was not with regards to whether the number of deals have gone up. I'm just trying to understand whether the deal size has increased. Has the wallet per customer, the wallet share per customer gone up? Because now we are seeing the same OEMs come out with a lot more in terms of, products. There's battery swapping. There's so much new technology within the ecosystem itself. So I'm trying to understand whether the wallet share has gone up from each client that you cater to, and if that would eventually mean better profitability for you.
Absolutely. So, a lot of the growth, happens from, mining of existing customers, winning new deals from existing customers. Of course, we do win new customers as well, right? But if you look at the sort of growth that we are happening, that cannot happen always from, winning new customers, right? So we have very long-term customers with us. And as their spends, go up, the R&D spends go up, we naturally tend to benefit because we have been providing service with them for, many years now. And naturally, there is a good confidence in the capability of Tata Elxsi. So definitely, a lot of the growth that we see are due to deep mining, increasing wallet share with the existing customers, and the overall deal size also is growing. So I think we're in a good position on that front.
Mr. Raghavan, on margins, could you tell us what's a comfortable margin band that you aim to be in going forward?
That's a tricky question, right? What is comfortable or not? I think we are in a good, in a good situation, and a lot of it is thanks to the superior operational performance that we have. And also the fact that we traditionally focus a lot more on offshore execution, right? We take ownership of customer projects, and then we deliver. We have the superior project management skills, the superior quality management skills. These help us in delivering value to our customers. So So we are more than happy with the sort of margins that we're having currently, and we would love to continue on this trajectory. But at the same time, we do have costs coming up. We do have wage hikes coming up. But having said that, we're pretty confident that we'll still continue to have a good margin performance.
Okay, all right. Let's talk about one of your group companies then. JLR, they were one of your largest auto clients, but you had once said that JLR contribution is has peaked out, and maybe in fact it will decline from here on. Give us a sense about that number. How much does it contribute, and where is that likely to stabilize?
No, I've never said that the percentage of JLR will continue to decline and so on. So if you look at it, if you look at at a time frame 3 years ago and to now, at one point of time, about 25-26% of our revenues used to come from JLR. We have managed to bring it down to about 10%. Right?
Okay. No, I just
that is also to avoid too much of a dependence on one single customer, and especially a group company. So to that extent, we have been fairly successful in growing other customers, and so we continue to have a great relationship with JLR. And as JLR's business continues to grow, we definitely tend to gain from the increased spend that they have.
Mr. Raghavan, could you give us some outlook on hiring? What does attrition look like now? Wage increases that you will have to hand out in 22?
Sure. So attrition continues to be an issue. I mean, it's not just for us, but it's an industry phenomenon. We are doing a number of things that to really control attrition. And at the end of the day, for a company like us, people are the greatest assets that we have. And a lot of the performance that you see today is definitely because of all the hard work put in by our employees. So there are a number of things that we are doing to ensure that we continue to retain them and give them a great career path moving forward. Regarding hiring, yes, we've added about close to maybe 450 odd people net in the last quarter. We would continue to do that in Q4 as well. However, for the next financial year, we are looking at a fresh addition. From a fresher perspective, we're looking at about 2,500 people from the campuses. And on top of that, of course, depending on business growth and so on, we will be adding laterals as well. So that's the.
Sure. Sir, I just had one final question. Got it. I just had one final question on the contribution that you would eventually see from the auto segment. Currently, I think 40% of your revenues comes from autos itself. Now with this, rapid growth that we're seeing, over the next 1 to 2 years, how much do you think you could take that contribution to?
No, I think right now auto is about 41-42%, and from a company strategy perspective, we have been very clear that we don't want over dependence on any one sector because we've had because of over dependence we've had issues in the past. So we are very clear that in a 3-year time frame, we would definitely want automotive to be about 40%, media and communication to be at 40%, and medical to be at 20%. Currently today, it's about 42, 44, and about 15 or so. And then we are moving towards that ratio that I outlined, 40-40-20. And that would be the preferred ratio for me.
Mr. Raghavan, it's a pleasure. Thank you very much for joining us and running us through what you are seeing for your business going forward.